looks like the trends that we've seen over the last few weeks are continuing. So all you buyers on the sidelines, you'll want to stick around to find out more about that. And we have a big week ahead with the latest CPI and PPI data coming out, plus global crisis that will have major implications in our very own economy. That's all coming up in today's market update, so let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest economic news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. So if you're new to the channel, welcome. If you haven't already done so, please consider subscribing to the channel and hitting that bell so you don't miss out on the data, tips, and analysis, keeping you ahead of the market trends. All right. So the trends continue in our local market, which is good news for buyers and a sign of unwelcome changes in the near future for sellers. But we also have some major stories developing around the globe that are indicating that inflation is worsening globally. And these issues may have frightening implications for the US as well. So without any further delay, let's get started with the week-over-week local market stats. All right, so in this week's 7 market update, we are going from new listings last week. We're at 904. This week we have new listings at 952, so that's up 52%, or just about 46 new listings on 48 new listings on the market this week. So that's welcome news again for you buyers out there that have been waiting. Again, this is another trend. We've seen this now 4 weeks in a row where new listings coming on the market have increased significantly. So that continues to be the trend. Solds are down. Last week we did have quite a significant uptick in the amount of solds. That just goes hand in hand with the amount of pendings we had the previous weeks. Again, it takes 30 to 45 days for those pendings to turn into solds. So that was why we had the uptick. That is related, that's a lagging indicator. Solds, those are things that happen 30 to 45 days previous. So now we're seeing solds go from $12.96 last week to $9.97 this week. That's down 23%. So again, that is right in line with our trends. We are seeing more listings coming on, less solds going off, which is indicating that the market is starting to change in favor of the buyers. So still not quite a buyer's market, still definitely a seller's market. It's pretty strong still, but we are starting to see the tipping point where it's starting to head the other way. Right in line with that is also pendings they did increase a bit this week from $12.77 last week to $13.16 this week. Not a huge jump, up 3%, up just a little over 40 listings that have gone under contract in 7 days, which is not a whole lot. Take in mind that is considering that some of them did go off market and turn into the solds this week, as well as some of them, did become new listings. So the other big thing to take a look at on this is, as I've mentioned in the last week's market update, the price decreases are increasing. So if you go back to February and look at the price decreases in the 7-day market updates for my previous videos in February, you'll see that they were hovering right around 180. Now again, this week we're up another 50 price decreases this week. So we went from 343 last week to 394 this week. That is a trend that has been continuing since February, and it just continues to increase. So that, to me, all of these are indicating that we are starting to see a market shift in buyer sentiment for sure. But I think we're also starting to see that sellers are realizing that they are starting to overprice based on the demand in the market currently. Total inventory breakdown. Again, this is sticking right with our last 3 weeks. Single-family homes went from 2,208 last week to 2,326 this week. That's up 118 again. Last week we were up 111. This is another 118 on top of that. So that's another increase. And then condos went from 1086 last week to 1202 this week. That's up 116. So if you look right underneath both of those columns, you'll see the net gain from last week's net gain was 172 new listings total. This week's net gain is 234 listings. So that's up quite significantly again, an additional 234 this week compared to last week. Multifamilies, we went from last week 95 to this week we have 106, which is up 11 new listings. That's quite a bit for multifamilies. That's 12%. And then foreclosures, we did see foreclosures go from 29 last week to 39 this week, up 10 or 34% in that department. So all of these are indicating that we are getting more listings on the market. Less listings are going off. Just the net gains we're getting is showing that the market is starting to shift. And I think that is going to continue as we move into higher interest rates for mortgages. Speaking of higher interest rates, this week, the interest rate went from 4.87 last week to 4.994 this week, according to Nerd Wallet. This is an industry average. And then we had bank rate go from 4.91% up to 5.06%. That's up 15 basis points this week. I do think with CPI data coming out tomorrow and then PPI data coming out Wednesday, I believe we're going to get an indication that the Fed is likely to raise 50 basis points in May, which will most likely increase the mortgage interest rates on the 30-year fixed. I would guess up to at least 5.5%. Or somewhere around there starting in May and June. So that's coming ahead. All right, let's get into the headline highlights. I'll just read these off for you for those of you who don't want to stick around through the actual news stories. But CPI and PPI data, as I said, CPI comes out tomorrow at 8:30 in the morning. PPI comes out Wednesday. So we're going to get those data releases. The expectations for CPI were at 8.5%. However, there was a story released today from the White House that suggests we may see extraordinarily high inflation rates this new reading tomorrow. Redfin, they saw that there were quite a few price decreases over the last month, and then they are also seeing a huge demand decline for vacation homes and secondary homes in the market. That's according to a new report that was released by Redfin. Consumer credit, this is a huge story that is going to have major implications in the economy and the market. I think it's something that not enough people are paying attention to. And then the final thing is global supply chain and food shortages. I mentioned last week very briefly at the end that food shortages was something that President Biden did say in one of his addresses, that it was going to be something, it was going to be real and something that people needed to think about. We're also seeing that the global supply chain shock is having a major impact on the food shortages. But we're also seeing stories globally pop up in more developing countries. Food shortages are starting to become a very serious issue and are starting to cause violence and riots in those countries. So we're going to take a look at those real quick. All right. First story, White House says it expects inflation to be extraordinarily elevated in a new report. Biden administration is bracing for the Labor Department's Consumer Price Index that's going to come out tomorrow at 8:30 in the morning to show that inflation is extraordinarily elevated. They're expecting the March CPI headline inflation to be much higher than the actual core CPI reading. And if you just compare it from last CPI reading that we had was last month, that went from 7.5% up to 7.9%. Again, higher than expectations a little bit. This month we're projecting it to be around 8.5%, but I'm wondering based on this headline if they're expecting it to be even higher than that. Now that gas is going to be incorporated into the CPI data, we're also seeing that food, places like Aldi's and German grocery stores have already told consumers that they're expecting anywhere between 20 to 50% increases in the prices of food. Aldi's, if anybody in Southwest Florida shops or even throughout the US shops at Aldi's, that was something that they already put out to their consumers and their customers. So those things being in the CPI reading, we're expecting higher inflation. UBS is projecting that we're reaching peak inflation. I don't see that happening anytime soon, honestly. I don't know where they're getting this idea from that we're going to be seeing the peak inflation this month when supply chains are so backed up. Food is becoming an issue everywhere, and the Ukraine issue is only making that worse. China is now in lockdown again. So again, these things are all just compounding the issues, and I don't see that being the case anytime soon that we're reaching peak inflation. Next, Redfin reports the share of sellers dropping their asking prices climbing past last year's rate. So fast-growing share of home sellers are dropping their prices. That's another sign that early in 2022, we're just hitting the end of the first quarter, beginning of the second. The housing frenzy is starting to ease as mortgage rates approach 5%, and in some cases are already above that. Demand for vacation homes also dropped sharply for the second month in a row in March. So that's with mortgage rate locks for second homes at their lowest level since May 2020, which at that time we were just in the beginning stages of the pandemic still, so and the shutdowns. So that's quite significant to be that at that low of a level for secondary homes, considering the housing boom that we've been seeing over the last 2 years. So as prices rise, Americans are turning to their credit cards. Consumer debt rose at the fastest pace in 20 years in February. So just to give you an idea and put this in perspective, it rose by $41.8 billion, which is 11.3% in February, but the projection was 15 billion. So if the projection was 15 billion, this is almost 3 times as high as what they projected. So that is a huge and significant increase in consumer spending with their credit cards. As I said earlier, the biggest thing that I would see as being the reason why more people are using their credit cards is because they got used to some of the stimulus money that they had. Their lifestyles may have changed, they might have increased, or they could be losing money in the stock market now because a lot of people did put that money into the stock markets and investments, in which case they've run out of money in reserves. They've also, if you take a look at the data on America's savings accounts, they've also run out. A lot of people have run out of their reserves and their savings accounts. And the typical statistic right now, I believe, is that most Americans, I think it's like 75% of Americans, would not be able to come up with $400 in an emergency. That was pre-pandemic. Now that we've run out of the stimulus, people have blown through a lot of their savings. We are back to the point where we were before the pandemic. And now we have inflation, which is really hurting Americans' pockets. The pay has not kept up with inflation rates. Therefore, people are starting to charge their regular goods, as many of the emerging countries have already been doing, which is why I would suspect that this is almost 3 times higher than the projected debt that we were expecting to see at 15 billion versus the 42 that we actually got. So Americans now owe a total of $4.48 trillion in consumer credit, which, as I said, would be a problem, especially if we are to enter a recession where there will be layoffs, and we've already started to see those happen across the mortgage industry and people fleeing the real estate industry who came in the good times. If that does start to happen, this combination of credit debt and debt with losing jobs and having already bought houses that were probably pretty high, to begin with, they might have been affordable, at a 30% loan to value ratio, but if that's the case, if people are losing their jobs, this is something that we would have to worry about, where the housing market could be impacted quite significantly. Just to give you an idea of what that looked like, as you can see, the huge line that goes down on this graph, that was right when the stimulus got released, where people paid off their credit cards. People were putting their money away, they were investing it. And now, as you can see, after that kind of went away, most people have the habits where they don't have those, core habits of saving and investing money the right way. If they don't know what to do with it, they're not used to having that kind of money. They usually spend it poorly, in which case they usually return back to their old habits. And I believe that is exactly what this graph is showing. And now we are at an all-time high for consumer credit, the highest that there's ever been since the 60s. In addition to that, why the global supply chain mess is getting so much worse, according to experts, Russia's invasion of Ukraine, which cut off exports from Ukraine, as well as the businesses under sanction in Russia. It set off a series of new supply chain bottlenecks. So the surge in COVID cases in China, which has led to temporary lockdowns in parts of the country. If you think about where we import a lot of our goods, we import most of them from China, and a lot of the food around the world gets imported from Russia and Ukraine, as well as a lot of raw materials that are necessary for things like microchips and actually growing food. Even though the United States produces a lot of food itself, we get our fertilizers. A lot of those raw materials to create those fertilizers come from that area in Russia and Ukraine. So those are some of the bottlenecks, but we also have the lockdowns in China, which are compounding those issues. And that's leading to things across the globe. So from Pakistan to Peru, soaring food and fuel prices are tipping countries over the edge. Global food prices are soaring again. The pandemic, poor weather, and climate crisis upended agriculture and threatened food security for millions of people before this happened. Then came Russia's war in Ukraine, making the situation much worse. So the spike in the cost of other daily essentials as well, such as fuel, which is Russia is where a majority of European countries get their energy from. Continuing on with the story, unrest in Sri Lanka, Pakistan, and Peru over the past week highlights the risks. In Sri Lanka, protests have erupted over shortages of gas and other basic goods. Double-digit inflation in Pakistan has eroded support for Prime Minister Imran Khan, forcing him from office. And at least 6 people have died in recent anti-government protests in Peru, sparked by rising fuel prices. But political conflict isn't expected to be limited to these countries. Again, that is just suggesting that these are things that are starting in developing countries. And if continued, if this type of trend continues, I do believe that we will see these kinds of effects in other more fully developed countries, even possibly the United States. It's just that these countries aren't, one, they're not the reserve currency like the United States, which is part of the problem, is that our inflation causes inflation to all these other countries that are on our standard, but that these things will have a domino effect and they will eventually reach our shores, whether slightly or more severely, depending on how long this persists and how severe it gets in these other countries. What do we need to keep an eye on? I think most of this stuff is pretty, we've covered this every week. Some of the things I have dropped off and changed around a little bit, but one, obviously, the biggest thing for us right now is the hawkish Fed and the recession, just because of job losses in combination with a lot of these other things that are going on in the economy. There's a lot of moving parts, and the Fed really is the one right now that is going to be making the decisions moving forward, and will really determine the outcomes that we see as we move towards their moves in May. And I think that's going to determine quite a bit of what happens in our economy here. Tomorrow, April 12th, 8:30 in the morning, we will get the new CPI data. Again, the White House said that they are expecting extraordinary inflation to show, so we'll have to see what those numbers look like. The CPI data is a lagging indicator as well, so that really indicates what's already happened. Whereas on the 13th, on Wednesday, we get the PPI data, which is more of the leading indicator, suggesting where producers' prices are going or have headed already. And that usually determines what the CPI data will be for the following month. So we'll have to see what the inflation rate and speed is, whether both of those move up or just the CPI data moves up, as UBS is suggesting will be the case. Also, global supply chain and food crisis, the future, that's going to be an indicator of future inflation. The supply chain itself is what's slowing down a lot of the recovery in all of our markets, especially housing, where we can't get the supplies to builders, so they can't build as fast as they plan to. And then you also have that is affecting the prices, because the less you have of a material, obviously the prices will increase with that, the supply and demand of it. So that's going to be an indicator of future inflation. China shutdowns and Ukraine war, we'll have to continue monitoring this. That is going to be indicative of the food crisis around the world, as well as supply chain issues and energy prices moving forward. Even though Biden is going to be releasing 1 million barrels of oil per day from our strategic reserves. And then lastly, we have consumer credit. We'll have to continue monitoring this and see if this does increase next month, because if that is the case and more people are getting into debt on their consumer credit cards, especially with interest rates going up, that means that those rates, if it's a variable rate card, which in most cases it is, you're going to be seeing higher interest rates as those interest rates increase with the Federal Reserve. The consumer credit interest is going to be continuing, and I've already seen it happen on my one of my balances. It did increase month over month as what the actual interest was, so I just ended up paying it off. So consumer credit, because that's going to be indicative of whether these houses and things that people are buying right now as investments are actually investments and assets, or they're actually liabilities and debts. Because if it's unaffordable or it's on the brink of being unaffordable and people are just charging their cards, they really don't have the money to pay them or pay for the basic things that they need, then those things that they were supposed to be assets really become burdens, and they become debts and liabilities versus the assets what they should be. So those are all things that we will have to continue watching out for. And this is just my take on the economy and what's going on. I'd love to hear about what you're seeing in the economy, what you're seeing in your local real estate markets. The more I learn from you guys in the comments below, the more data that gives me and the more ideas it gives me to create more stories for you guys in the weeks ahead and keep you updated as much and as best as I can in your markets as well. So please feel free to leave a comment below, and we'll see you in the next one. Thanks for watching, and if you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to our Southwest Florida MLS. If you have any questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. Thanks again for watching to the end, and I hope to see you next week.